Sir Isaac Newton could calculate the movements of celestial bodies, but he couldn't calculate the madness of crowds. When the South Sea Company bubble inflated in 1720, the architect of classical mechanics succumbed to the mass mania and lost his fortune. Compare his failure to Osceola McCarty. She spent her entire life working as a washerwoman in Mississippi, living simply and walking everywhere. With no formal education and a fraction of Newton's income, she quietly amassed $250,000. Long-term wealth relies on systemic discipline and engineered design rather than intellectual horsepower. In 1973, economist Burton Malkiel published a thesis that shocked Wall Street. He argued that stock market prices move along a random walk, making short-term predictions a statistical impossibility. We are going to systematically dismantle the most common active stock-picking heuristics and replace them with a mathematically optimized passive portfolio. This framework relies strictly on the academic proofs established by Malkiel and financial strategist Charles Ellis. Individual intelligence cannot outsmart the collective, instantaneous pricing mechanism of global markets. Professional valuation is split into two opposing camps. The conservative approach is the firm foundation theory, championed by investors like Warren Buffett. It calculates intrinsic value strictly based on concrete assets, dividends, and future profits. The opposing view is John Maynard Keynes' castle in the air theory. Keynes argued that actual worth is irrelevant. An asset's price is dictated entirely by anticipating the psychology of the masses, guessing what the next buyer is willing to pay under emotional pressure. This pricing strategy relies completely on collective momentum. When investors start buying simply because others are buying, prices detach from their foundation and inflate rapidly until the psychological tension snaps. The historical record is littered with these collapsed castles. In the 1630s, status-driven Dutch citizens traded plots of land for a single Augustus tulip bulb, driving prices up tens of thousands of times before the collective delusion broke and the market crashed in a week. We saw the exact same mechanism during the dot-com bubble. Investors chased tech hype, pouring millions into companies like Pets.com, despite zero profits, only for the stock to vaporize into bankruptcy 268 days after its IPO. Human nature consistently succumbs to the fallacy that this time is different, proving that in the short term, markets are driven by unpredictable crowd psychology rather than rational calculation. This unpredictability is what makes technical analysis a losing game. Technicians study charts and look for visual patterns to predict future price movements. In reality, they are applying the human brain's pattern recognition software to completely random data. This chart shows a standard stock's price history. If you zoom out from a 1-hour scale to 1 month to a full year, the jagged, randomized shape looks identical at every level. It is an illusion of intentional design at any scale. Think of it like a massive coin toss experiment. If 1,000 people flip a coin 10 times, pure statistical probability dictates that at least one person will get 10 heads in a row. They will declare themselves a market guru, but their success is entirely statistical luck. Quantitative research shows the correlation between yesterday's price and tomorrow's is nearly zero. Because the market has no statistical memory, prices don't follow a trend. They wander randomly. Fundamental analysis faces a similar structural barrier. Even if an accountant identifies a company's true value, the information becomes public and is instantly absorbed. If thousands of investors recognize a stock is undervalued at $50, they buy simultaneously, driving the price to its target immediately and erasing the opportunity for a consistent profit. The speed at which markets price in news ensures that neither chartism nor accounting can generate consistent excess returns in a competitive environment. The barrier that prevents accurate market timing is known as the efficient market hypothesis. At any given moment, high-speed arbitrageurs instantly absorb historical trends, public reports, and breaking news. They execute trades so quickly that all available information is locked into the current price, neutralizing any analytical advantage. This presents a distinct engineering problem. If prediction is impossible and information is instantly priced in, what mathematical lever does the investor actually control? The solution is Harry Markowitz's modern portfolio theory. It provides a scientific method to optimize the risk-return trade-off. This graph maps return against risk. To measure risk, we use a metric called beta, which tracks an asset's volatility relative to the broader market. A high beta stock moves with extreme vertical swings compared to the baseline. To fix this, you combine entirely uncorrelated asset classes. Adding bonds, real estate, and international equities visibly narrows your horizontal risk spread while the vertical mean return remains steady. It eliminates catastrophic concentrated risk. While certain market anomalies do occasionally appear, like short-term momentum or the January effect, trying to exploit them involves high transaction costs and heavy penalties for being wrong. The profit window vanishes before you can secure it. Modulating portfolio beta through broad diversification is the only controllable mathematical lever available to investors. We can now translate the academic theories of the efficient market and modern portfolios into strict, actionable execution rules. Rule number 1, fire your active managers. The standard hedge fund fee structure charges 2% of total assets and 20% of profits, which virtually guarantees only the manager gets rich. This chart compares a standard index fund against an active fund over 30 years. Because compound interest works in reverse for costs, that 2% fee consumes roughly 30% of your final capital. The alternative is to simply buy the entire market efficiently. By utilizing ultra-low-cost index funds that track broad metrics like the S&P 500, you guarantee average market returns while cutting expenses to near zero. Your allocation must extend beyond U.S. stocks. A truly resilient portfolio incorporates government bonds, real estate investment trusts, and equities from emerging markets to ensure you aren't heavily exposed to a single nation's economic downturn. Over time, growing assets will unbalance your portfolio. By executing a mechanical, calendar-based rebalancing once a year, selling the assets that went up and buying the ones that went down, you automatically force yourself to buy low and sell high. To adjust for age, Malkiel offers a simple life cycle formula. An investor's percentage of bonds should precisely equal their age. A 25-year-old can survive aggressive stock market swings. A 60-year-old cannot afford a 40% capital loss right before retirement. The final layer is behavioral defense. Maintain a 6-month cash reserve so you never have to sell stocks to buy groceries. Avoid high-interest credit card debt entirely, and maximize pre-tax havens like IRAs to let your money compound unhindered. Mechanical, passive execution removes emotion and friction, proving itself mathematically superior to active speculation. The reality of modern finance is clear. Global markets are hyper-efficient machines, where exploitable anomalies are fleeting illusions. For the vast majority of investors operating without server farms and PhD teams, passive indexing yields the maximum risk-adjusted expected return. Behavioral humility, the admission that predicting the future is a statistical impossibility, outperforms analytical arrogance in every market cycle. Market crashes, panics, and euphoric runs will occur. Reacting to that noise, attempting to time your entry and exit, is the single greatest destroyer of personal wealth. The optimized system distills into 4 hard rules. Automate your savings, target zero fees, maximize global diversification, and ignore the market noise. Buy the total market, ignore the daily charts. Let compounding execute quietly in the background for decades. True wealth generation is a boring, disciplined routine. It thrives precisely because it rejects the thrill of the gamble.